I'm joined now by Oladele, founder of the Money Wit Club, to help us review some of our top stories in more detail. Good morning and welcome to the show. Great to see you, Ola. Happy Valentine's, I guess. Where's your red?
I missed the memo.
Yeah, you're rebelling. It's okay. It's okay. Alphabet, 100-year bond. Alphabet is Google's parent company, 100-year bond at 6.125%. I mean, massive confidence in the AI boom, or what is it? I mean, it's a tech giant, but what does this bond issuance signal?
So the first thing is to put it into context. What are they trying to do? They are trying to fund an AI bubble or AI boom, as we would say, by raising debt as against capital, as against equity capital.
Right.
Now, the idea is that AI obviously is capital intensive and they don't want to dilute their shareholders. So they are going into the debt market. And but the idea of this 100-year bond is that they are saying that they are here.
They're here to stay.
They're here to stay.
Right.
And you would see Google in 2021, 26. That is a mouthful, right? And so that's what they are trying to tell the market, that they are here and they're here to stay. And they believe that AI is also here to stay. And so come with me on this journey, on this AI journey, and let's make money together. That's basically what they're saying. But for the markets, it's a little disconcerting because, like you mentioned earlier, that Motorola had done something like this in the past, and right after, we just saw a decline in the company. And where is Motorola today? And there's this talk about the bubble, and if there's going to be a bubble, this is some of the signals that
maybe there's a bubble.
There really
but
is
I mean,
bubble.
If you're issuing a 100-year bond, it doesn't sound like you believe this is a bubble. But you know, Ola, it brings me then to the fact that you then have companies like OpenAI and Anthropic, who are raising. I mean, Anthropic's $30 billion. You know, Anthropic is technically a startup, right? $30 billion with a post-money valuation of $380 billion. Is this over-exuberance? Is it disciplined capital allocation? You know, help me understand the dynamics of what investors are actually looking at investing in with these companies.
So yes, AI, I think, is here to stay. But what it will look like, I mean, we can't get to this level of speed and then pull back from it. So AI is here to stay.
Right.
Now, the question is, who is going to find that positioning that will make it scale and scale profitably?
Right.
So that is what this race is all about.
So you believe Anthropic and OpenAI are some of the companies at the forefront of that type of scaling?
Exactly.
Right.
And then it's also capital intensive, such that money needs to be put in before we see if it will come back or not. Now, this is where the whole concern about the bubble or not comes in, because Anthropic was valued at 180 billion just in September. What has
happened since
between then and now for it to be valued at 380 billion? Is this really a real valuation compared to the fact that they declared 14 billion in revenue?
So annual revenue, that's
annual
the run
revenue,
rate,
right? So it's almost like, are we sure that these things that we are creating is going to generate the level of revenue to cover for the investments being put into it? That's the concern, but it's also the risk. And the higher the risk, the potentially higher the return. So we just have to wait and see. But obviously there is something in AI. I believe it is here to stay, but how it will monetize it is what's not clear.
Well, I mean, AI infrastructure is part of the big deal, but looking at these valuations, you went from 180 billion, you're now at 380 billion. Could we see an Anthropic and OpenAI enter the $1 trillion valuation benchmark, like an Nvidia or an Apple in a few years?
In a few years, yes. I do not. If you look at the rate at which they are growing, and if you look at the companies that are backing them, there is a very high chance that they would enter those levels. But there's also a chance that at some point they might end up listing, because these are really massive. Think of them like utility companies. They are massively valued companies, right? And their comparables are like utility, high intensive capital companies, right? So I do not rule that out.
And it's interesting because now some of the top companies are still part of that AI value chain. You have the chips, the semiconductor manufacturers like Nvidia and co. So really that whole tech industry, and not just the tech industry, the AI infrastructure, the software side of it is now starting to dominate the markets. But interesting, we'll be watching that one like hawks very close in coming years. The Central Bank of Nigeria has approved the participation of BDCs, allowing them to buy up to $150,000 a day. I mean, $150,000, what does that amount, threshold, signal about what the CBN is trying to do? Are we still in liquidity management mode here?
So I think CBN is actually entering into liquidity management mode now.
Right.
In the real markets, every day, everyone, individual markets. Before now, there was no access. They couldn't directly buy from the banks, but they are saying, let's give them cash. Let's flood the black market, the parallel market, so that prices will come down. Before now, CBN had focused on stabilizing, fixing the fundamentals, building our reserves, correcting the errors in the system, creating some structural balance, right? So I think it is a good signal because CBN is saying we've come to the point where we can focus on trying to fix the pricing on the streets, right? So I think that's where we are. And in terms of liquidity, I think what we would end up seeing is that it would be aligned with where the interbank market is priced. And we will see a closure of that gap where there is no difference between you buying from a BDC or buying from a bank.
Yeah, that's interesting. Do we risk introducing more opportunities for arbitrage here?
So the way the interbank market is right now, I think it will be tough because I will presume that a trader in the bank selling to the BDC will be selling at market and maybe a few bips over, right? That's one. The only thing that might be an issue is giving that supply and then we're sliding into a political season. So that changes the dynamics of the conversation.
So when you say you were sliding in the political season, what do you mean specifically?
So usually we find there's a trend towards elections where there's pressure on FX because it's easier to move money around. The BVN conversation, pricing money, moving money across banks in Nigeria is easier to flag. So if you give cash to BDCs, right, in an election season, then there's a chance that there could be more pressure on that market. So the thing that the central bank is trying to fix may not necessarily work just because of timing.
Okay, interesting, very interesting. We'll be watching the election dynamic because it's always a concern for market watchers. Let's go to Dubai. Dubai's luxury property boom. You know, when I heard this, I was like, duh, it's Dubai. But $10 million average apartment prices in the luxury end. Is hard assets like real estate, do you still see them as a long-term store of value, given some of the property market shenanigans we've seen in places like China, where the whole sector has just come under a lot of pressure?
So I would look at it from the perspective of Dubai as UAE as a country, and then Dubai as a location. There is an attraction for the UAE currently, and when there is that attraction and there's a flow of people, then people
what is the attraction? What's driving that attraction?
So there's a millionaire move globally where people are running away from their high tax areas to a zero tax location. That's one. Then if you consider the pricing of premium property in New York, in Hong Kong, in London, you know that Dubai is still cheap. So if you are looking for investment for the future, as a wealthy person, Dubai is still
and in fact, in
location.
places like London, capital gains tax on property is
significant.
Really significant.
Exactly. So with these kind of things, you know that Dubai as a location, and even from it's a quiet, it's not in any political tension, you know, it's just people just trying to enjoy themselves and be okay. There's an attraction of people to Dubai, to the UAE, such that if people are coming, they need to have places to stay. And as long as they have to have places to stay, whatever pricing you put on it, there will be demand.
Yeah, indeed. And so tell me, in terms of looking at real estate now, and even from a geographic perspective, in terms of your portfolio as an alternative to other asset classes, as being a store of value compared to bonds, for instance, how are you situating it now in 2026?
So land will always be scarce. That's one thing that we all need to understand.
Land will always be
Land
scarce.
will always be scarce. It's one of the hardest things for you to create more of, right? Such that as world population grows from 8 to 10 to whatever we decide to arrive at in terms of world population, you would always need houses. And the houses will keep going higher to accommodate that. Such that, from that perspective, give real estate time. Eventually, in a good location, as long as there's political stability, what you would find is that value would still increase. People must live in houses.
And how do you see interest rates? I mean, interest rates are, I think, moderate, relatively high, but how will that impact those sorts of investment decisions?
So what you would consider is the cost of funding, right? If we are talking about Dubai, even as a non-resident, you can get access to mortgage, and the mortgage are single-digit levels, such that it also fuels the demand for property. Right. So from that perspective, in terms of financing, I think it's still a good story to tell.
Fantastic. So Mercedes-Benz said its 2025 earnings have more than halved on a massive $1.2 billion hit as a result of Trump tariffs. So it's having a broad impact on automakers. Tell us about what we can expect for the auto industry as a result.
One of the things I need to look at is the level of competition. China is not sleeping. China is fully awake right now. And where Mercedes is struggling, one of the causes of their struggle is not just the tariffs, it's the fact that whilst they had 20 to 30% of their revenue coming from China, the Chinese luxury vehicle market is upping their game seriously. So there's a lot of competition from there. And then when you now consider there's some tariff conversation between Europe and China, China retaliating and Mercedes getting caught in the crossfire, their cars are getting to China more expensive than they would ordinarily be when the locals are also improving on their quality and all that. So it's almost like double whammy for them. Now, the question is, how would they be able to maneuver?
Right.
They had tried to invest in EVs. It didn't quite work out, or they are still in the journey of figuring themselves there. And they're also trying to go back to their regular engines that we know. But it's a lot. And I think it's just the business cycles, right? How they are able to maneuver and navigate this tight season, possibly negotiate, lobby with their own governments to see what they can get. But it's a tough season.
Yeah, and so, typically we say that the main driver competitiveness for Chinese vehicles and automakers is low cost. Do you agree with that, or is there some other dynamic now that is particularly putting Chinese automakers at an advantage over their European peers?
I think their investments in research.
Okay.
They are producing very, very intelligent solutions, right? So whilst there's cheap labor, and even that conversation is changing.
It's changing,
yes,
it's
it's changing. But if you look at the things that they are producing, they are high tech, very intelligent, and very beautiful. So it's really tough. So beyond just what we can see that they've spent time on research to get to this point. It's almost like an unveiling of the things we've been doing quietly and hiding on that cheap labor. So it's more than just cheap labor.
And just looking at it from a consumer perspective, in certain markets, there's still a brand premium that certain European automakers have over Chinese cars. Do you think that will gradually erode? So, for instance, if you were, driving a Mercedes versus, I don't know, what name, BYD or something, is that brand premium still going to be a competitive advantage for European automakers, giving all these other pressures?
We just have to watch and see.
Right.
And see how a Mercedes, for example, would evolve, right? They might have to move to other markets because competition in China, I'm not sure is going to step down anytime soon. But that whole brand idea, it's a lot of marketing. So they would have to find a way to position themselves effectively for
Interesting, very interesting perspectives. Oler Oladele, founder Money Week Club. Thanks for joining us on Business Week. Great to always have you.